No, it doesn't work like that, because if everybody has one thing that they pick, you can't do any loss harvesting with that.
No, absolutely. So if you're looking here, tax loss strategy, you've got, let's just say SPX there. That's the S&P 500. So the S&P 500, if you have a 10% return, that's what you got.
Oh, I see. Yeah.
That's your net there. That's all you're going to get.
That's it. You buy the one thing, you sell the one thing. That's it.
And so if you have an individual account, why are you doing that versus saying, hey, well, you know what? I can build this out like an S&P index. You could model it out, or if you just have, let's just say in this example, I built out 10 stocks. Some of them were the top holdings of VU.
Some losers.
Popular, but then some losers in there. I mean, Target's in there. Amazon, actually, the 3-year look back here, Amazon's actually down. And so when you're going to sell off, you have the opportunity to then basically sell off some of the losers and some of the winners to literally tax loss harvest. But you can't do that owning just VU. You cannot, it's not going to work.
Or even a couple ETFs, because then you have all this overlap. You have two positions, and whether you're using the FIFO method or LIFO method inside of your account, by the way, the default is FIFO. But if you're doing that, you go
first in, first out.
First in, first out. If you think about it, you sell part of your SPY or whatever it is that you have. Well, you're selling the first shares that you bought that have the highest gain on it. So it doesn't work that way.
Yeah. And when it comes to that, the basic breakdown that people get so confused, they say, well, if I'm selling shares, I bought the shares at, let's say $10, now they're $20. Okay. Well, when you sell though, your gain is the $10. It's not the whole share. So it's not like, well, everything's a gain that I'm selling. So if you have an account with $100,000 and it grows to $110,000, it doesn't mean you cash out 10 grand and it's all gains. That's not the way it's going to work.
More people, every time when the tax forms come out, more people go, that's not my gain. And I'm like, I guarantee you it's your gain. Now, the tricky part, get this question all the time. What if you have short-term and long-term capital gains? Like, how does all that work in terms of the IRS? So I'm going to break it down really simple, use a really simple example, and then you can attach your numbers. First thing you do is you total up your short-term gains and your short-term losses. Put those in a column, whatever that ends up being. You made some money, you lost some money, short-term, held less than a year. Then you total up your long-term gains and your long-term losses. Those go in their own column. From there, you then put both of those together, the result of both of those. So your net result of your short-term, whatever it is, a loss or a gain, versus your long-term loss or a gain. So simple example here is you add up all your short-term trades for the year, you had a loss of $1,000. You add up all your long-term trades for the year where you sold and bought or whatever, you had a gain of $1,000. You now have a net reportable loss of nothing, right? It's what it is.
Yeah.
So think of it that way. And when you do have that result, in this case it's zero, but if the result were minus $4,000, well, $3,000 of it can go against your short-term or against your ordinary income. The rest can carry forward until you either use it the next year by having gains to offset it, or you just put it on your taxes, and that's the end of it.
Yep. No, it's one that everybody gets confused, and nobody really quite grasps that. So if you take this experience here now you can realize, okay, I'm going to take, all of my losses and my gains, but if you only own one fund, it's whatever's the net return. There's, you're always hoping to be positive, but if you build it out properly, you're going to have some winners that maybe still get you that same gain or maybe more, but you're still going to have some losers. It's going to happen.
Yep.
Nobody can pick perfect. And so that's where this tax loss strategy comes into play.
Any of our clients, when they look inside of their funds, they're going to see, I have lots of positions. So when someone calls me and says, I need $10,000 or whatever, I'm going to look to see if I can play that game that I just explained and make them end up with no capital gain or loss by pitting short and long term against each other. Or if they need the capital loss, that's a chance to do it, right? I need 10 grand to go buy something. At the same time, can I get a $3,000 capital loss or more? We can do it. If you only owned SPY or VU or the XLK or something, it gets tricky, right? But you think you're doing the right thing. Oh, I'm being diverse. I'm using an ETF or a mutual fund. You can do better. And that's where the real secret and kind of strategy comes in with tax loss harvesting.
Yeah, and when people are taking a Roth conversion, in the years that they're doing a Roth conversion and they're saying, well, hey, I need money out of my taxable account to pay my taxes because you don't want to pull from the IRA more money to pay the taxes.
Yep.
That comes into play right here, because if you can take a loss or at least take a break even those years when your income needs to be lower, then when you have lower income, then you can say, hey, guess what? I'll take the long-term capital gains because it's 15%, let it ride. But you got to remember, everything accounts for that modified adjusted gross that adjusted gross income when you're doing the conversions. Yeah, it's only 15% on the long-term cap gains, but that's going to bump up your total adjusted gross income.
Bonus topic there.
I'm talking about.
I like it, man. At the end of the day, if you work for the IRS, I still love you. I just hate your job. I don't want to pay more than I'm supposed to pay. At the bottom line, they don't tell me how much I'm supposed to pay. I'm just supposed to guess. So I want to strategize ahead of time and do every little thing I can, whether you have a couple dollars or you have a couple $1 million. I don't care. Play the game.
Yeah, and speaking of jobs, I got fired from my job at the bank today. Old lady came in, asked me to check her balance, so I pushed her over.
I swear to my life, I was just thinking of that. Did you see it online or something?
No.
I'm not joking at all. I was literally going to say, what a coincidence. I got fired from my job. That was the exact joke I was going to say.
My client, Rob the man. I'm shouting out Rob for that right there. So
Rob's our people.
Our client.
He's our people then, because we're all right there. Somehow we all saw that joke. I was like, oh my God.
There it is.
Wow. All right. Well, hey, thanks for watching. I won't even share. I got nothing. I got that. You got me on that one. And that was a good joke, I think.
Thanks. Appreciate that.
There you go.
Appreciate that compliment.
All right. Well, enjoy the rest of your day, and thanks for watching. Let's get back to work.